Okay, we'll today start with pending areas of international finance. Let me complete that and then I go back to your interest rate futures, options and swaps. So 5 topics of international finance, I think 5 to 6 topics of international finance is pending, and interest rate futures and options is pending, and topic 5960 is pending. Today we'll start with an area called as money market hedge. Just a minute. Now earlier when we had started with international finance, we had learned the basics, and then finally the focus was on hedging of the exposure. In hedging, the first technique which we learned was currency invoicing, then we learned leading and lagging. We also learned about forward contract. There were areas which I left out, which is money market hedge, which was not covered. So we did not cover money market hedge. We also have not covered currency options and swaps. So there are multiple ways of hedging our exposure. We are done with technique number 1, currency invoicing. Technique number 2, leading and lagging. Forward contract netting was one more technique which we learnt. Forward contract was done, which was your technique 4. Today we will go to the technique 5, which is money market hedge. We did not do money market hedge, so today we are going to do money market hedge. Now what does money market hedge want us to do? Now listen, I have done sales and I am going to receive 1 lakh USD. This is the amount I am going to receive. 1 lakh USD is the amount which we are going to receive. No, you will have to move to the other side. Leave it, I'll do it in some time. Okay, sales is 1 lakh USD. Now this money we are going to receive after 3 months. The problem which we have is, if this 1 lakh get realized at the rate of 66, I make profits, but if it gets realized at the rate of 64 or 63, I end up making losses. To protect us from this, we learned that I can tell the other guy that I want to bill in INR itself. That was first technique. Then we learned leading and lagging, saying that I'll lead the receipt, lag the receipt, all that we learned. We also learned about forward contract. Now the next thing which we are going to learn is money market hedge. What does money market hedge says is that you prepare a balance sheet on day 1. Imagine a balance sheet on day 1 and see whether the exposure will be an asset or a liability. So this exposure which you see here, 1 lakh USD, is it your asset or is it your liability? Is it your asset or is it your liability? Asset. If you have an asset, create a dollar liability by taking a loan today. Create a dollar liability by taking a loan today. So if you have an asset on the balance sheet, you have to create a liability. Now today if I prepare a balance sheet, it's $1 lakh. Even after 3 months I'll get only $1 lakh. This is an exposure where no interest can be charged. So today you have sold at 1 lakh and you have given him a free credit of 3 months. So what they are saying is, balance sheet on August 31, there will be an asset $1 lakh. Against this there will be a loan, but loan can't be $1 lakh. Loan will be some 98,000. Why 98,000? Because you have to pay interest on it. This balance sheet August 31, as it proceeds forward, on November 30, what will happen is, you will get the $1 lakh and give the 1 lakh loan repayment, because you have taken a loan of 98,000 which is going to mature to 1 lakh. This is the broad thing which you are going to do in a in money market hedge. What we are trying to do is, for an asset we create a liability, for a liability we create an asset, and we cannot create the asset or liability of the same amount, a little lesser amount. Why little lesser amount? Because we end up paying interest or receiving interest. Now what I am going to do is, this is my transaction 1, sell goods and you have a receivable of $1 lakh. This is your transaction 2. You have taken a loan of 98,000. Now I am now going to sit idle with this 98,000 loan. What I will do is, I will immediately convert it into INR. I will do an immediate conversion of into INR. So I am least bothered what happens to currency movement. Let it go to 75, let it come down to 65. So immediately I will convert this into INR. Now if I am in need of money, I can utilize this. If I am not in need of money, I will create a deposit out of this. I will create an INR deposit. Take a USD loan, create an INR deposit. This INR deposit will mature to some 64 lakhs. Some number I am putting. This will mature to some 64 lakhs on the maturity date. Now this is a certain amount. Anything happens to the currency, you will get 64 lakhs. Earlier your worry was this $1 lakh can become 62, can become 66, can become 68, can become 70. So you are protecting yourself from this movement by ensuring that you will get only 64 lakhs, nothing above that, nothing below that. That is what a money market hedge does. You are trying to create a matching asset for a liability or a matching liability for an asset. The moment you have created this, you are nowhere bothered whether currency moves up or currency comes down. Clear? Any doubts in this? This is a broad thing which we do in a money market hedge. Money market hedge involves creating a matching dollar liability for a dollar asset for an exporter and vice versa for an importer. Steps in case of exporter importer both are given. We'll directly do it in the problem. I'm going to directly solve it in the question. Let's do question number 1. An exporter is a UK based company. Invoice amount is $350,000. Credit period is 3 months. Exchange rates in London are rates of interest in money market. Compute and show how a money market hedge can be put in place. Compare and contrast the outcome with a forward contract. Rework the problem if the tax rates are given. Please go through the question. Okay, now let's start with the money market hedge. The problems which you will face in an MMA, which is going to be your bid and ask rate, whether to divide, multiply, whether to use bid rate, ask rate. So the same thing which we have learnt in the basics, not new for us, but that's going to be again the challenge here. Are we an exporter or an importer? Exporter. So this is our asset. Against this asset, I need to create a liability. Clear? Any doubts on this? Now let's start. Creation of MMH. Creation of money market hedge. Step 1, identify the exposure. The steps can be a little different from what I have given there. Broadly the same thing we are going to discuss. Identify the exposure. What is the exposure we have? You have to write receivable / payable and the amount. Is it a receivable or payable? Receivable of which currency? USD 3,50,000. Any doubts on this? Step 2, take an USD loan, which will mature to USD 3,50,000 take an USD loan which will mature to USD 3,50,000 in how many months we are required to pay this? 3 months. I'm going to take a loan now. The loan has to mature to 3,50,000 in 3 months. What is the USD borrowing rate? USD borrowing rate is 9%. So 3,50,000 divided by 1 plus 9% by 4. Why divided by 4 is 3 months interest. 9% is for the year. So 1 plus 9% divided by 4. You are basically dividing by 2.25% of interest on the loan exposure. 2.25% is added to the denominator and you divide and take a loan. 1 plus 9% divided by 4. When you write, please write along with the currency, whatever amounts you are writing. USD, 2 decimal answer. 3,50,000 divided by 1.0225. It is 3,42,298.29. So I'll go to a US bank and say, okay, boss, I'm going to receive $3,50,000. Why don't you give me a loan against it? He says, great, I'll give you a loan of 3,42,298. You're going to receive this money, so let's take a loan, and they are ready to give me 342,298.29. Any doubts on this? Any doubts on this part? Step 3. Convert USD into GBP at spot rate. Convert USD into GBP at spot rate. You have decided to take a loan. You have taken the loan. Now you are going to convert this loan into your own home currency. What is the known component? What is the unknown component here? USD is the known component. Unknown is GBP. So GBP is equal to USD into GBP is equal to USD into GBP by what are we going to do with the denominator currency? Bank is going to buy. Bank will buy at bid rate. We are going to sell. Bank is going to buy. Bank will buy at the bid rate. If we have GB per USD, use it. Otherwise, 1 by ask USD per GBP. USD is 342. 298.29. 342 298.29. Bid GBP per USD is, it is USD per GBP is what is given. So we'll have to do 1 divided by ask into 1 divided by 1.5905. $215,214. Currency is very important. 2,15,214. $2,15,214.27. 215,214.27. $215,214.27. Any doubts on this? So we had a 3,50,000 of receivable. Against that, bank gave me a loan of 3,42,000. I have converted into my currency. Step 4. create GBP deposit of create GBP deposit of 215,214.27, GBP deposit of 215,214.27 for 3 months. What is the rate of interest for GBP deposit? At 5%. I take the money and create a deposit. If I don't want to create a deposit, I'll use it to repay loan, whatever the company wants to do. Create GBP deposit of 215,214.27 for 3 months at 5%. All these transactions happen on day 0. Whatever we have decided happens on day 0. Day 90. Step 5. Day 90, step 5. Receive money from customer and repay loan. So I get the money, I don't even do a conversion of it because I need not do any of that. I receive $350,000, whatever be the currency rate, I just pay $350,000. So I have kind of netted my exposure, received from one party and paid to the other party. Net I don't have any foreign currency exposure. I had a 350,000 receivable, against that I have a 350,000 payable. So I am not bothered about what happens to the currency. At one place I will gain, other place I will lose. Step 6. GBP realization equal to, we created a deposit now, on that we will earn interest now and we will close the deposit. GBP realization equal to, what was the rate of interest? 5% is for a year, take the proportionate rate. This is what I am going to realize. Irrespective of what happens to the interest rates, I am going to realize 217,904.44. This is the amount of money we are going to realize from this transaction. GBP 217,904.44. The amount of money which will be realized by us. 217,904.44. Any doubts on this? This is not gain, this is the money which I have received. I cannot tell this is a gain, no. I would have received, if I had done none of this on day 90, I would have received 350,000 into some rate. I don't know that rate. So we have freeze the rate and we have got 217,904. This I cannot tell is my gain. This is the money which we have received. So I am going to do next is the comparison with forward contract. So this is also certain, forward contract is also certain. I can decide what I need to do on day 0. Practically after doing all this, you may still make a notional loss because spot rates can be far better. So currency has now depreciated to 70 level. So people who would have taken a forward cover would have felt great at that point of time, but now they will feel there is a loss of return, there is a loss which they are having because they could have converted at the rate of 70 now. So that is something which is speculative. So we are not bothered about speculative. Risk management, see, the most important thing in any corporate or any organization is, or wherever you are doing a project, is having a certainty. Even if I am generating a lower return, I am perfectly fine with it as long as there is a certainty that I am going to receive the same amount. I don't want a highly fluctuating returns. A lot of people know, even finance professionals know, that equity markets give a better return than debt markets. But still, a lot of chartered accountants also avoid investing in equity markets because it's volatile. You don't know the risk. Whereas debt markets will steady state give you 6 to 7%. You are perfectly fine with it, even if it gives a lower return. So what we are doing is we are providing a certainty to the cash flows. Speculative cash flows can even go up to 50 lakhs, can even come down to 0. So that is not in our hand. So we are in the chapter heading is risk management. You are trying to reduce the risk of a company, because in a case of a company, what they are interested is their product is getting sold, there is a gross margin on the product. Let me make that margin. I don't want to make any margin on the currency rate movements. So this will ensure, this is one technique which will ensure, okay, boss, you will get 217904. Is it a profitable trade or not? Decide today itself. You say this is a profitable trade, go ahead and close it. That's all. Well, will it be a profitable if my cost is 2,10,000? My cost is known on day 0. My revenues are known on day 0.
If you convert it into USD dollars and after in day 90, this GBP amount, will it amount to 3,50,000?
No.
It will be higher than that?
Higher, lower, anything can be.
So if it is lower than that, then why will I choose this?
I don't know, no, what can happen. It can be higher, it can be lower, no. That's the...
Day 0, we will be certain about these transactions to happen at day 90. Because
Which transaction? Spot rate you need, no? You said no converting. I need a spot rate to convert in day 90, no? Forward, I agree. So I'm going to compare it with forward. I can decide whether to do forward or money market hedge. But you tell me the forward vis-a-vis spot, what I need to do, I don't have an answer to it, because spot is something which is uncertain. Anything can happen. So this gives certainty. Now they are saying compare and contrast the outcome with a forward contract. Forward contract is something which will ensure on day 0 what realizations we are going to have. Next working note. Computation of inflows under forward contract. Computation of inflows under forward contract. In that point number A, the company is an exporter. The company is an exporter. Having an exposure of USD 3,50,000. Having an exposure of USD 3,50,000. Full stop. It will take a forward contract. It will take a forward contract. It will take a forward contract to sell dollars in future. It will take a forward contract to sell dollars in future. Now, like we did a calculation here, same formula I will use GBP USD into, just that I am going to use these rates, the 3-month forward rate, and I can be certain what is going to happen. We will be certain that what is going to happen. So come down then, known component USD 3,50,000, known component USD 3,50,000, known component USD 3,50,000, unknown component GBP, let's write the formula. GBP is equal to we will receive this money only after 3 months, but I am able to calculate it today what I am going to receive. GBP equal to USD into GBP by USD. What are we doing with USD? Selling. Bank is? It will be on entire 3,50,000. There it was 3,42,000 because you are doing the conversion on day 0. Here you are doing the conversion only after 3 months. 3,50,000 into 1 divided by 216,852 point. This is an amount which we know on day 0. I know that I'm going to receive 216,852. I also know that I'm going to receive 217,90, whatever number we had calculated. Now it's my choice what I want to opt for. I can opt for today itself. Which is better? Money market hedge or forward contract? Yup. What is the confusion? Which is better? Money market hedge. Wherever we are receiving more money, I don't know why are you thinking money market hedge is going to be a better scenario because it is 217,904. Here it is 216,852. I have done this analysis on day 0 itself and I have decided. Now can there be anything better than this? Yes, a spot can be better. That is can be. You are not sure whether it will be better or not. But these two are certain what is going to happen. So now right below that, the company should go ahead with the money market hedge. Should go ahead with the money market hedge. Go ahead with the money market hedge as the receivable under MMH, or as the realization under MMH. As the realization under MMH is better. Realization under MMH is better as compared to forward contract. Realization under MMH is better as compared to a forward contract. As compared to a forward contract. Clear? Any doubts on this? Done? Can we proceed? Now, they are saying rework the problem if the tax rates are given. Now, what is the use of the tax rates is, this deposit rate you see 7%. This is no more a 7% deposit rate. The 7% is for dollars and 9% is for dollars. What is the tax rate in USA? 40%. So this deposit rate is only 4.2%. 7 into 1 minus tax rate. It's no more a 7% rate. It's only 4.2%. Similarly, the loan is not 9%. It's only 5.4%. The loan which we are taking is only 5.4% because net I'm going to pay only 5.4%. I'm not going to pay 9% because there is a tax benefit associated with your interest payment. Similarly, UK the interest rate is 30%. So this is 3.5, 5.6. Now you can start from the beginning as if the problem gives you these numbers. It's no more 7,958. It is only 4.2, 5.4, 3.5, 5.6. Just like the part 1 of the question. You have to start from the beginning. Your loan amount to be taken and all is going to change now because the interest rate is no more 9%. It's only 5.4%. Similarly, the deposit rate is no more 5%. It's only 3.5%. Any doubts on this? Any doubts on this? Start doing these 6 steps again. Start from the beginning, identify the exposure, take an USD loan, do all of this from the beginning. The interest rates are going to be different now. you'll have to first identify the exposure. If it's a receivable, you will get a loan. If it's a payable, you will create a deposit. For the loan amount, you will have to divide by the interest rate of the US, which is no more 9% now. Then you will convert into GBP. You will create a deposit in GBP, receive money from customer, and then finally GBP realization. This would be your calculation. Any doubts in this? Exposure is 3,50,000. I'll take a loan amount 1 plus 1.35 percentage. 1 plus 1.35 percentage is the denominator. Your interest rate is 5.4 percentage now, no more 9 percentage. So 5.4 means 1 plus 1.35 percentage. You convert dividing by 1.5905 as you had done earlier. You create a deposit and you earn an interest of 0.875 percentage. The interest which we earn is only 0.875 percentage. 3.5 percentage divided by 4. Net we will get this amount 219,025.24. If the taxes are also given, our realization is 2190. This is after tax realization. This is the post tax realization, removing the interest income taxation and interest expense taxation. Net what we will get is 219,025.24. Any doubts on this? Clear? Can we proceed? Any doubts on 219,025? Done? Anybody has any doubts on this? Can we? Let's move to question number 2. A UK company owes a German company 25 lakh euros payable in 3 months. The spot rate is there. Company can borrow, deposit, it can borrow, deposit. How much is the cost of MMH? What is the forward rate? What should the company do? More or less similar, just that we are going to do from an importer. Importer will become little tricky. As you do, you'll understand that importer is going to become little tricky. So let's start. Step 1. Identify the exposure. Identify the exposure. What's the exposure? How much? Payable of which currency? Payable of 25 lakh euros. So I have a payable. Against the payable, what should I create now? Asset. I have a liability. Against that I have to create an asset. Now listen, last time we had an asset, against that we had to create a liability. So we had an asset, we went to the bank, we created liability, we were done with the analysis. Now the problem here is, I have a payable. Against this I will have to create an asset. Step 2 will not be asset creation. Step 2 is just an amount calculation. You cannot create an asset because you don't have money. To create an asset, you need money. So step 1, we have identified the exposure. Step 2, we will identify what deposit is to be created. Step 3, we will identify how much loan is to be taken for this deposit to be created. Step 4, we will take the loan, convert and then create the deposit. So it is not that you can straight away go ahead and create the deposit. Deposit can't be created. This will be critical when you do a bid or ask analysis in some time. You will understand the criticality of this point. In step 2, I am just identifying the amount. I am not creating a deposit. We are just identifying the amount. After identifying the amount, I will understand how much is to be created. Clear? Step 2. Identify the amount to be deposited. Identify the amount to be deposited that will mature to 25 lakhs euros. In how many months we have to pay this? 3 months. What is the euro deposit rate? How much? 10%. I can deposit at the rate of 10%. 1 plus 10% divided by 4. 1 plus 10% divided by 4. 24 lakh euro 2439,024 2439,024.39. This is the amount of deposit to be created. I don't have this money in hand, because if you assume this money is there in hand, you will do a mistake in identifying your bid and ask rate. You will end up doing a mistake in your bid and ask rate. I need this much money. I need this much money. Any doubts on this? I have to create a deposit of 24,39,024 euros, and for that I need so much money. Any doubts on this?
So can we do it the other way around, like we can export it from the euro side and then
Why will you do it from that side?
why? Because the question is silent about
Where is it silent? A UK company owes a German company, so your starting is from a UK company point of view.
I can't start it from the German company point of view and then do
No, I think it starts from an UK company point of view. The wording is little, well, I could have made the wordings a little better, but the context is very clear. It's a UK company which owes a German company. The context could have been made a little better, but it's from an evaluation from UK company's point of view. And from a German company point of view, you cannot do any evaluation. No, Germans are going to receive euros. For them, it's a home currency, no?
Yeah, like they will be the exporter on this part and the same.
So why, no, so let them be for example, last problem, we were to receive some $350,000. The other party was to pay dollars. No, US company will not be bothered about it. No. A UK company owes a German company. For German, it's a home currency. Why are they going to do anything? They just need to pay 25 lakh euros. Okay, now we have understood that we need to create a deposit. Step 3, identify the amount of GBP loan, identify the amount of GBP loan to be taken to create the above deposit. I'm just again identifying the amount. I'm yet to even do anything. We are just identifying the amount of GBP loan to be taken to create the above deposit. Known euro 24,39,024.39, known 24,39,024.39, unknown GBP let's write the formula. GBP is equal to euro into GBP is equal to euro into what formula? GBP by now comes the trickiest part. What are we going to do with euro? Think about it. That is where I said I have been telling you from the beginning what am I doing. I have just calculated the amount. I don't have that money in hand. Let me be very clear. Now think about the flow of transactions and tell me what are you going to do with euro. Do you want to buy euros or sell euros? To sell euros I need euros in hand. Do I have any euros in hand? Do we need to buy euros or sell euros? Now let's understand it from a normal flow of transaction. Normal flow of transaction, what will happen is I'll go and create a, I'll go and take a GBP loan. I'll take a GBP loan. That's what I'm going to do. The GBP loan amount I don't know, but let's assume it's 10 lakhs. This GBP loan you're going to convert into euros. After converting, you're going to create a euro deposit. That's why I said it's a little complicated. It's not the same way. We calculated the amount, but that is not the money in hand. Now some of you have understood that this is the money which we have in hand, and that's why you are saying it is to be sold. I don't have that money in hand. I need that money. To need that money, I have to buy euros. I need 24,39,000. It's not that I have 24. Last when we did receivable, we had that 3,42,000 in hand. So we did a direct conversion. Now I don't have 24,39 in my hand. What I'm going to do is I'm going to buy this 24,39. How am I going to buy? By taking a loan. Have I taken the loan? No. I'm just calculating. In step 4, I'll take the loan, then do the currency conversion, then create a deposit. First we are doing the reverse working, and then we are going to do the normal working. So we are yet to complete the reverse working part. So what are we going to do with the euros? We are going to buy euros. Bank is going to sell. Bank will sell at ask rate. Be very careful about this, otherwise you will end up making a no. You can borrow euros also, no? You can borrow euros, you can borrow pounds, you can borrow anything you want to. It can borrow euros, it can borrow pounds. Why we are concluding it is I need 24,39,024 euros. I am a UK based company. UK based company will have only pounds with them. So I need euros. So to get euros, you will have to buy it, and buying will happen at the ask rate. Last problem, we had surplus USD. So we sold the USD. Now I need euros to create a deposit. Clear? Any doubts on this? It's a little complicated, not the normal way of thinking. So you will have to be very clear on this. If there is a doubt, let me know about it. Okay. So do this. Ask GBP per euro is 1 divided by 1951 219.51. And now this is the stage where I will go to the bank and ask for a loan. Now only I'll ask for a loan to the bank, because now only I got to know how much loan is required. Till now, earlier it was very simple. We knew the loan to be taken, because loan has to be taken first and then deposit has to be created. In first problem we did, loan was calculated easily. Now only we have come to the loan amount. So step 4, take loan. Now write step 4, take GBP loan. Take GBP loan, convert into euro, take GBP loan, convert into euro, and create a deposit. Last problem, when we did the step 2, step 3, whatever, the take GBP loan was a step 2, conversion was a step 3, and create a deposit was step 4. We had written it. Now we had done the reverse working, and I am writing it as a single line entry here. We had done the calculations as well as created the deposit directly. Any doubts on this? Deposit which we have created in step 4. Yes.
Yeah. So in step 3, instead of doing this calculation, we can first get the amount of loan in euros and then convert.
Why will you take a loan in euros?
We'll take a loan in euros and then convert it into GBP.
No, why a loan in euro? If you take a loan in euros, you already have a euro liability. On top of that, you are increasing your liability, no? Your balance sheet won't tally, no? Your balance sheet liabilities will increase, no? Euro liability. That deposit is created because you have a payable in hand, no? You have a 25 lakh payable. Now, what is the point of creating one deposit and one loan together? That is just wasting money, because on deposit you will earn lesser interest, on loan you will pay higher interest. There is no point in creating a loan and a deposit of the same currency, no? It's just waste of money, because loan will be at 12%, deposit will be at 10%. We are not going to earn anything out of it. So practically nobody will create a loan and deposit of the same currency. Any doubts till this? Any doubts on this? You'll have to visualize what is going to happen. See, the objective is, when I create a balance sheet with the currency, for example, in this case euro, I'll create a balance sheet where I will only write euro exposures. So receivable, if it is there, against that there is a deposit. If payable is, receivable, against that there is a loan. If payable is there, against that you create a deposit. You are trying to tally your balance sheet in terms of currency. Basically, netting of your exposure, one payable exposure with a deposit, receivable exposure with a loan. Step 5, all this now will happen on day 90. Step 5, redeem deposit and pay supplier. I'll be creating a deposit of 2439 that will be redeemed and I'll pay back my supplier. I'll redeem the deposit and pay the supplier. Any doubts on this? Some of you look a little confused. So, what is the doubt in the earlier one? Where is the confusion? Be clear on the logic behind the calculation rather than understanding or rather than remembering the steps.
Then if by step 4 the GBP which loan we are taking, so that what is the corresponding asset we will have?
GBP is my currency, no? Why do I need an asset against that? GBP is my own currency, no? I don't need an asset against that. And maybe there will be an asset, no? Your balance sheet anyway will tally, so there will be some other asset. So that's my own currency. I'm not bothered about it.
In this question I have to pay. So based on that currency I'm taking the loan and
No. You need to pay which currency you will have to see. You need to pay euros against payable of euro. You need a deposit of euro. Against a deposit of euro, you need to take a GBP loan and then you proceed with the calculation.
but in question 1 I'm having receivable of dollar. In that scenario
Against a receivable of dollar, you need a loan of dollar. Receivable of dollar, take a loan of dollar. Same thing, no? Asset liability matching, what is the confusion? Here you had a liability, you created an asset. There is an asset, you created a liability. What's the confusion? You are getting into the step 2, step 3 and all. Let's go step by step. So logically tell me where is the gap. I have a dollar receivable. If I have a dollar receivable, I need to create a dollar loan to make them balance. In this problem, I have a euro payable. Against a euro payable, I need a euro deposit. Now where is the confusion? Go through it. If you have still a doubt, let me know. Any doubts in this? Now step 6. Repay loan along with interest. This is my final payable. Repay loan along with interest. The only good thing is this payable will be in my home currency. That is what I wanted. Repay loan along with interest. I have taken a loan of how much? 1951 219 point into what's the interest rate for GBP loan? 8%, so it will be effectively 2% for a quarter into 1.02. 19 lakh 90,000 243 point I have to pay this much amount 1990 243.90 19 lakh 90,000 243.90 GBP. I am making sure that this will be my liability. Whatever 25 lakh euros I have to pay, whatever be the currency rates, I will pay 19 lakh 90,000 243.90. That is what the objective of any technique will be, MMH or forward contract, protecting us from the currency movements. So we are kind of now protected from the currency movements. It's 1990 243.90 GBP of payable. Any doubts on this? Clear? Can you proceed? Now, how much is the cost of money market hedge? We have done GBP 19 lakh 90, whatever number we had got. What is the forward rate? What should the company do? These are the next two parts. Any doubts till now? Now, what is the forward rate is? They have not given us any forward rate, but through our operations, we can find a forward rate now. Now, right, expected forward rate, underline that. Expected forward rate, underline that. 25 lakh euros equal to 25 lakh euros equal to GBP 1990 243.90. This is what the expectation is. 25 lakh euros equal to GBP 1990 243.90. 1 GBP is how many euros? You can divide and tell me then finally. Euro 25 lakhs is equal to GBP 1990 243.90. Let it be a 4 decimal number. Euro 25 lakhs one GBP equal to 1 point this is what our analysis says. Key, this should be the rate in the market, 1.2561 euro. The forward contract today ideally should give me this rate, 1.2561 euros. Because both are certain, money market hedge is also certain and forward contract is also certain, so both should broadly give us the same answer. So according to the analysis, 1 GBP should be 1.2561 euro. Any doubts in this? Okay, what should the company do is the next question. Okay, we have decided that the ideal rate is 1.2561 euro per GBP. That's what our analysis says. In future, this should be the rate. Now, what should the company do? It all depends on what is company's anticipation of exchange rates. If a company doesn't have any view, they are not sure what is going to happen, go ahead and do a money market hedge. But they may have a view which says it can be more than 1.2561 or less than 1.2561. It can be according to them 1.26 or it can be them according to 1.24. If they think it is 1.26, that is higher rate. If they think it is 1.26, should we do MMH or not? If they have an expectation of 1.26, think logically and let me know. They think that will be 1.26, so should I do MMH or keep it open? If I do MMH, it's 1.2561. Why keep it open? No, that's 1.2561. The MMH is 1.2561. Let's ignore forward contract. Your expectation is that it can be 1.26, it can be 1.24. If it's 1.26 expectation, should you take a MMH or leave it open? Leaving it open has its own set of risks, so that's okay. That's a company's choice. 1.26. GBP 1.2. This is the rate, 1.26 euro per GBP. Now tell me what you want me to do. Okay, 1.2561 is the rate which is the right rate. If it's 1.26, I will not be taking a money market hedge, I'll keep it open. Why open is I'm going to divide by 1.26. It's not multiplication with 1.26. Keep that in mind. It is division by 1.26. When you divide 25 lakh by 1.26 is how much?
19 lakh.
And vis-a-vis this is 19 lakh 90,243. So why should I take a money market hedge and pay 1990? I can as well keep it open. Clear? Now, right, the decision on money market hedge. on money market hedge would depend on the expected spot rate of the company, would depend on the expected spot rate, full stop. If the company has no view on exchange rates, then it should go ahead and take a money market hedge. Next point. If the company believes that expected spot rate can be more than euro 1.2561 per GBP, then it should keep the exposure open. So alternatively, if the view it is going to be less, then it should take a MMH. You can write it. Alternatively, if you believe that it's going to be less, go ahead and take a MMH. If there's no view, go ahead and take an MMH. There's no point in keeping it open. If you have a view, then it all depends on what is the expectation. You believe more than 1.2561, keep it open. Less than 1.2561, go ahead and take it. Any doubts on this? Clear? Can you proceed? Let's move to question 3. Go through the question. Okay, now there's an Indian company which has exported its goods and it's worried about a depreciation of pound sterling. What happens if a foreign currency depreciates for an exporter? Receivables will reduce because my assets are depreciating now. Assets are kind of depreciating. In fact, all exporters would be very happy because the currency has depreciated in India. When INR depreciates, it's a favorable scenario for exporter and an unfavorable scenario for an importer. In this case, they are believing that pound sterling will depreciate and INR is going to appreciate. So they are really bothered about it. Looking at the interest rates, what should happen? What does IRPT say? Which currency should depreciate? INR should have depreciated. So somewhere this guy's expectation is entirely different. The interest rates are entirely different. So let's do an MMH and cover the transaction. Once I do MMH, I'll be protected against this. I'm not going to be impacted in any way. If you believe that in the interim period, currency can appreciate, INR can appreciate, but money market hedge will take care of mine, because what he believes is 5 lakh into 56 can become 5 lakh into 54 or 53 for him. Whereas MMH will make him to get 5 lakh into 57 or 58, because that is what IRPT says. When you have a low interest rate, ideally your currency should, high interest rate, ideally your currency should depreciate, but that's not happening, or at least the expectation is not that. Now, right, step 1, identify exposure. Identify exposure. What's the exposure? Receivable of USD, GBP or USD? Okay, GBP. Receivable of GBP 5 lakhs. Receivable of GBP 5 lakhs. Identify the loan to be taken. Loan amount. I have a receivable. Against that, I'm going to take a loan now. Loan is 5 lakhs divided by, what are the interest rates in UK? 5%. So 1 plus 1.25 percentage. 1 plus 1.25 percentage. The loan amount is 4,93,827. 493,827.16. This is the amount of loan which we are going to take. Step 3. Convert GBP into INR. Convert GBP into INR. I'm directly doing it, not showing known, unknown and all. You complete the steps, balance steps. Step 4 is creating an INR deposit. Step 5 is collecting money and repaying loan. And finally, step 6 is INR deposit maturity 276.54,321 plus 12%, so another 3% gets added to this. This is what we'll finally realize, 2 crore 84 lakh 83,950. Broadly, this is the amount we are going to realize. Two crore 84 lakhs 83,950, which is, if I divide by initial exposure of 5 lakhs, I am in fact realizing at the rate of 57, whereas our worry was that it can fall below 56. The worry for the other person was it can fall below 56. MMH will ensure that we realize it at 56.97. Any doubts on this? Because ideally the interest rates have to only, the currency has to only depreciate. Now, right, the company should take a money market hedge. Ideally, I should have written that in the first. Initially, we should have written these points. The company should take a money market hedge. To protect itself from likely depreciation of pound sterling. Full stop. The steps for the same. To protect itself from depreciation of pound sterling. Full stop. The steps for the same is provided below. This should have been the ideal. Ideally, I should have started with this. Okay, we are done with MMH. I'll move to the next area, which is a miscellaneous area called as Nostro, Vostro and Loro account. These are three different names in international finance. You have different kind of accounts which are there. The first type of an account is called as Nostro account. The understanding may not be that critical from problem solving point of view, except for maybe 1-2 places where I may ask a question on this. In a Nostro account, what happens is this. Our Indian bank having a foreign currency account with the bank, a bank's foreign currency account maintained by a bank in foreign country and in the home currency of that country. So when an Indian bank goes to USA, they have to have a USD account. That USD account, an Indian bank like an ICICI bank having a dollar account with the Citibank in USA, having a dollar account with the Citibank in USA. That is what a Nostro account does. Vostro is exactly opposite. The Citibank USA, when they create a rupee account with ICICI Bank, Citibank USA having an INR account with ICICI Bank India. What is this Loro account is, in case the Indian INR account, the ICICI Bank wants to transfer some amount from their home currency account, that is in India, they want to transfer to their Nostro account. If they can do a direct transfer, Loro is not required. Loro will come into picture in case ICICI does a transfer to a bank in maybe UK, and from UK the funds are transferred to this US bank. If there is in between any account which comes in account wherein the bank remits funds in foreign currency to another bank for credit to an account of a third bank. So in case in between, if there is an account which comes in, that's called as Loro account. What is Nostro, what is Vostro? Nostro account is whatever the account which ICICI Bank, it's technically called as, I think the definition is our account with you, your account with us. That is what Nostro and Vostro means. Nostro is our account with you. Vostro will mean your account with us. That is, your account is Citibank account with Indian Bank in India. So with the ICICI Bank in India. So these are the three forms of accounts. Now from a problem solving, maybe one place I may tell you to understand this. Next thing which we are going to learn is exchange position versus cash position. Now, what is exchange position versus cash position is, a company takes a forward contract. When you take a forward contract, would you be having any risk? Let's assume there is no base currency at all. You just want to start speculating now. You want to start speculating and you take a forward contract. The moment you take a forward contract, the foreign currency, let's assume the dollar is the currency for all our discussion, dollar and INR. I take a forward contract in terms of dollar. I go ahead and take it. If I prepare my balance sheet, there is no asset called as a dollar, there is no liability called as a dollar. If I have a real asset called as a dollar and a real asset called as a real liability called as a dollar, that is called as cash position. If you have a real asset or a real liability, what is exchange position is you have already taken the risk, but you don't have the asset in hand. You have already taken the risk, but there is no asset in hand asset. So that is called as exchange position. This risk will get realized in few days, whether it can be a positive one or it can be a negative one. Exchange position is cash position plus or minus future payables or receivables of dollar, plus or minus future payables or receivables of the dollar. Now this transaction regarding exchange position and cash position is more important from a bank's point of view, not from individual's point of view like us. Now there are 4 transactions which can affect a foreign currency in a bank. One is cash flow, telegraphic transfer. If you do a transfer of funds, so I call my bank and say, please pay $50,000 to a supplier in US. He will make the payment. The moment he makes the payment, his cash position, that is his dollar, will come down. Also the exchange position will also get impacted. Exchange position is cash position plus or minus future payables and receivables, all put together. What is the risk we have? All risk put together is reflected in exchange position. So something which is going to impact cash position will also impact the exchange position. Second, demand draft. Demand draft will only impact this. It will impact your cash position only when the demand draft is realized. You just go to bank and Citibank and say that, can you give me a DD of $1 lakh? He gives me a DD of $1 lakh. Exchange position is impacted because there is a future payable or a receivable for Citibank. But the cash position will get impacted only if the DD is realized by the person to whom you have given it. So you give a DD to someone, that DD has to be realized. Similarly, bills purchase, it will be yes here, it will be no, one will be impacted only when it is realized. Similarly, forward purchase or sale, yes, no will be impacted only on delivery. Now let's take some transactions to understand this better. Let's assume one bank has $1 lakh, USD 1 lakh. It also has exchange position of USD 1 lakh. Exchange position, cash position, both are 1 lakh with them, which means there is no future payable, no future receivable. Just now I am going to start my business, or the bank is going to start the operation. A customer comes and says that, give me a demand draft of $40,000. I give him the demand draft. What will happen is, this will continue to be 1 lakh. Because when I give demand draft, nothing happens to my currency balance, it remains same. But somebody would receive this money, somebody will get this demand draft and he will present it to us in few days whenever he wants to present. The moment he presents, my real balance will come down. So DD got created. This will be 1 lakh, your exchange position is 1 lakh plus or minus future payable. There is a future payable which is sitting on top of you now, because this future payable can come at any point of time. It can come immediately, it can come later on. So this will become USD 60,000. This will become USD 60,000. You have created a demand draft, cash position remains same, exchange position comes down because you have a future payable in hand now. Then DD got realized. This becomes USD 60,000. This remains same USD 60. Why USD 60 is, there is no future payable or receivable now for me. I don't have any future payable or receivable. So every transaction is going to impact your exchange position. In this case, is the exchange position impacted? Yes, it's impacted. How it has been impacted is the 60,000 would have come down to 20,000, but I don't have a future payable now. So it again goes back to the 60,000 level. The formula is your cash position plus or minus future payable. So now you don't have a future payable. So you end up going back to your 60,000. We'll now start doing a problem. There are 4 types of transactions which we have discussed. If you have immediate cash flow, both will be impacted. If there's a future cash flow, only one will be impacted, the other one will not be impacted. Let's do a problem on this. Yeah. Which one? Loro account. In a Loro account, what happens is your ICICI bank wants to deposit $500 crore to an account in USA Citibank, but I'm not able to directly transfer it. So I take the help of a bank in UK. I transfer the funds to them. Could be XYZ reason why we are not able to transfer, I don't know, but there could be a reason that happens. When you transfer the money to a third party bank, that account which is maintained in the third party bank is technically called as Loro account. And what this guy is going to do, take the money and transfer it to our Nostro account. Or depends, if maybe I transfer in pounds because I don't have USD, and I tell that guy I am transferring pounds, you convert into USD and then transfer it. Maybe that could be the reason I'm not doing a direct transfer. Yes, obviously charges, whatever is that will be your additional cost. So could be the reason what you are indicating. Maybe I don't have the USD with me, so I give it to the GBP account and that guy converts into USD and then transfers it. Clear? Let's do this question, topic 52, question number 1, page 190. You as a dealer of foreign exchange have the following position in Swiss franc on October 31. What steps would you take if you are required to maintain a credit balance of Swiss franc 30,000 in Nostro account and keep us overbought position on Swiss franc 10,000? Go through the question. Okay, let's start doing it. Now write exchange position, particulars, purchase, sale. Then we have cash position, particulars, I'll call it as receipt and payment. Purchase is related to receipt, sale is related to payment. Exchange position, purchase and sale, cash position, receipt and payment. You are selling means you are giving it to someone else. You are buying means you have an inflow of currency. You are selling means you are giving it to someone else. This is the currency which is getting sold. I am not talking about the other part. In both you can start with opening balance. What's the balance in the cash position? how much? 1 lakh. I'm writing it in the receipt side. This is my opening balance. 1 lakh in the receipt side. If I receive more, this 1 lakh will keep going up. If I pay, the 1 lakh will come down. Opening position exchange, what they mentioned, over bought. So this is also on the purchase side. You have purchased, you are in an overbought scenario. That is, you have kind of purchased more currency than what you have sold. Technically, your opening balance is 1 lakh plus some future payables or minus plus future receivables minus future payables. So kind of we have got 50,000 balance. Now let's go transaction by transaction. First transaction is purchased a bill on Zurich. I have purchased a bill. When I purchase a bill, my currencies are going to go up. My exchange position will go up. I have purchased a bill. When I purchase a bill, only the exchange position is impacted. Once the realization for this happens, the receipt will also go up. So now write purchase of bill, 80,000. Purchase of bill 80,000. Purchases will increase my balances, sales will decrease my balance. I'm purchasing, it's like, let's understand this is a raw material. If you purchase your raw material, your balance will go up. If you sell your raw material, your balance will go down. You have purchased it, but what have you said is, I've entered into a purchase transaction, but the money will come after 10 days or 15 days, the raw material. You have purchased a raw material of 80,000, but that raw material is yet to be received by you. So the moment it is received, this balance will go up. But as of now, this balance only goes up. It's a future receivable for you. What's the next transaction? Sold forward. TT means telegraphic transfer. Sold forward means again the realization of this will happen in some time. I don't know when the realization is going to happen. They have to tell me. If it was sold spot, then I'll write in both the places. If it is sold forward, or if they say realization of a forward, then it will not come in exchange. It will come only in the cash. So sold forward next. Sold forward. You have sold your raw material now, but you are saying I will supply the raw material only in future. I am yet to supply the raw material. Sold forward TT how much? 60,000. These are just contracts which we have entered. I have entered into a contract to buy. I have entered into a contract to sell. The moment I buy, my currency balance will go up. The moment I sell, my currency balance will come down. So these two things are yet to happen. What's the third thing I have done? From someone I had to buy it. I told him I'm not going to buy, let's cancel it. It's again not going to impact my cash position. From someone I was to buy some 30,000. And I'm now saying, boss, I'm not going to buy it, let's cancel it. Where do you want me to write? Purchase or sale? Sale. It is going to be written in? Sale. Purchase or sale? Sale. It's purchase? So it's coming in sale. It's a purchase negative, so it will come in your sale. So cancellation of forward purchase. Cancellation of forward purchase. You went ahead and cancelled this future payable or receivable for you. So that is some 30,000. What is the next transaction? Remitted by TT. Now remittance means it's a cash flow which is going to happen. If this remittance is again a spot payment, if some transactions happening today, it will impact exchange as well as cash. If the remittance was for some past purchase or past sale, if it was against some past transaction, then it will come only in the cash position. It will not come in the exchange position. Now this remittance is going to come in both 75,000 and remittance 75,000. This transaction will appear at both the places. Remitted by TT. When you make a remittance, see, there are transactions like this. If you enter into a forward purchase contract, only cash position. Forward sale contract, only cash position. Bill purchase, only forward purchase, forward sale, bill purchase, draft preparation, all this will impact only exchange position. Realizations of a DD, realization of a bill, honoring your forward commitment, honoring your sale commitment, all of this will impact only cash position, because first it has already impacted your exchange position. Second, now the realization of that is happening, it's going to impact your cash. Yeah.
It should be in receipts.
Payment, or you have remitted, no? Remitted by TT. I have given money. Not received, no, remittance.
Then we can adjust it against that purchase bill which we have.
So kind of it's happening, no? It is written in 75,000 on the sales side, no? Technically it's happening that way only, no? Your remittance is being written as a sale entry, no? So if a transaction impacts exchange position, it is going to impact your cash position in few days. But there are certain set of transactions which will impact both. There's only one which is immediate payment or immediate receipt. When you have an immediate payment or an immediate receipt, it will impact both exchange position as well as cash position, and remittance by TT falls under that category. It's an immediate remittance which you have done. Any doubts in this? Any doubts in this part? Clear? Can we proceed? Any doubts? What's the next transaction? Draft on Zurich cancelled. Now we had purchased this bill of 80,000. A part of the bill is getting cancelled now. You are cancelling a part of the bill which is there. So again it's going to come on the sale side. Cancellation of draft on put a total now. Closing balance 65,000, closing balance 25,000. Okay, sorry, there's a small mistake, sorry. This was purchased a bill and this is draft. Sorry about it. Let me just explain again. That was a purchase. These two are not linked with each other. What is a draft is a demand draft which has been created. Demand draft is for a payable or for a receivable. Is it a purchase transaction or a sale transaction? Demand draft which a bank creates for a foreign currency. It's a, okay, is it outflow of a foreign currency or an inflow of a foreign currency? It's going to be an outflow of your currency. So it was technically an initial sale transaction, and when you cancel it, it will come here. I'm extremely sorry about it. I took it as a purchase of bill. It is not bill, it is draft which is given. So whatever original draft which you had taken, you are kind of cancelling that draft now. Draft involves a payment originally. Now it is cancellation is like a receipt of money for you. So technically it's like a purchase transaction. So just write this 30,000 this place. Complete this. I'll explain it again in some time. It's a little complicated area. So go through this. I'll explain it again in some time. Okay. Now I'll explain the entire problem from the beginning. If you're done with till this, listen for some time. There will be a purchase and sale in case of your exchange position. This purchase and sale is equal to receipt and payment. When you purchase, you receive foreign currency. Let's take it as raw material. Let me keep it very simple. It's a raw material. You either purchase or sell your raw material. After you purchase or sell your raw material, you will receive the raw material, or you have to issue the raw materials, something of that sort. Receipt and payment, purchase and sale. Now I had an opening balance of 50,000 of overbought, opening balance of 1 lakh. Now the moment I call my supplier and say that you have to give me a raw material, it is recorded as a purchase transaction. But the real cash flow or the real raw material receipt happens after some 30 days, after 20 days, after 10 days. So overbought position or your exchange position indicates how much risk you have in hand, because there can be some future payable or future receivable. Now what does this technically opening balance of 50,000 indicate is against that 1 lakh of receipt, you already have some 50,000 payable to be done. So net what you have risk is only to the extent of 50,000. Every transaction given in the equation, you have to understand whether it's a purchase transaction or a sale transaction. Just understand it that way. If it's a purchase transaction, write it in the purchase. If it's a cancellation of purchase transaction, write it as sale. Similarly, is it a sale transaction or a cancellation of sale? So let's first only fill the exchange portion. Don't bring the cash portion into picture, because if you do swapping between both, kind of confusion is happening. So what was the first transaction? Purchased the bill on juries. Very clear, it's a purchase transaction. So I write it in the purchase side. Sold forward. Sold forward means sale transaction. You write it in the sale side. Any doubts till now? Purchase, sale. Forward purchase contract cancelled. Cancellation of a forward contract is your purchase contract, is your sale. Remitted by TT. Remittance means money is going out. Remittance means money is going out. So it will get recorded in the sale side. Draft on juries cancelled is draft is a DD which was created. Earlier you had written a sale transaction. Draft is a sale transaction. When you cancel the draft, it's a purchase transaction. Any doubts in this? Any doubts in any of these items? Clear?
The last one, sir, how?
Draft means it's a sale of currency.
Which means already I've issued a draft.
You have already issued a demand draft. So when you issue a demand draft, you have recorded that you have sold $40,000. When you issue a demand draft, you have already written an entry, sold 40,000 Swiss franc. Now the customer comes, says, boss, I'm going to cancel this transaction. I don't want this draft. Can you pay me the money which you have taken and cancel the DD? So I had done a sale transaction. When I cancel it, it's like a purchase. Any doubts on this? Now, when it comes to cash position, if you purchase a bill, it will not impact. Sold forward will not impact. Cancellation of a contract will not impact. Cancellation of a draft will not impact. Only the remittance is going to impact. Remittance is the only transaction which is going to impact. Any doubts on this? Any doubts in this? So net I have this balance now, 5,000 and 25,000. Closing balance of 5,000 in the sales side and a closing balance of 25,000 is there. Sorry, I should write it in this side. Closing balance is 25,000. This side it's 5,000. Closing balance is 25,000 and 5,000. Any doubts on the closing balance figure? This 25,000 indicates that you have currencies of 25,000 in hand as of now, and this 5,000 indicate an oversold position. Like you had an overbought position, now you have a oversold position. Any doubts till now? Now what is the requirement? How much balance you want to maintain? You want to maintain a balance of 30,000. Listen, spot, like you had an opening balance. If you have a balance in the purchase side, it's called overbought. If you have a balance in the sales side, it's called oversold. Now what is oversold? Technically it is your cash balance plus or minus future sale transaction. It will become a little complicated, so I'm not getting into detailed explanation. For the time being, what you can understand is if you have a closing balance on the purchase side, it's called overbought. If you have a closing balance in the sales side, it's called oversold. Any doubts on this? Any doubts on this? Clear? Can we proceed? Now, my requirement is I need a balance of how much? Listen for some time, don't write it, listen for some time. You need a balance of 30,000. So what I'm going to do is spot purchase. I'm going to do a spot purchase 5,000 and final closing balance 30,000. Any doubts on this? I'm going to do a spot purchase. The moment I purchase that, I'll get this 5,000 here and my balance will become 30,000. A spot purchase will go and sit here also. A spot purchase will go and sit here also. Listen for some time, listen for some time. Spot purchase will go and sit here also. And now, again I'll put a total. And now the closing balance is 0. You don't have any balance itself. In case of overbought or oversold position, nothing is there. Listen for some time. You needed a balance of 30,000, so you went ahead and purchased raw material worth 5,000. Your balance went to 30,000. Here it has also impacted your exchange position. That has now become 0. What is the requirement they are saying? 10,000 overbought. So I need to write 10,000 somewhere here. I need a 10,000. So purchase forward, and you will get your balance of 10,000. When you purchase forward, your nostro account, your cash position will not get impacted. Only the exchange position will get impacted. Any doubts in this? Please note it down. Please note it. I'll give you some pointers once you are done with this. They will keep doing this. These two accounts will get created on an everyday basis. Okay, now write few points. Point number 1, the company had a closing cash balance of 25,000 Swiss franc. The company had a closing cash balance of 25,000 Swiss franc. And an exchange oversold position of 5,000 Swiss franc. And an exchange oversold position of 5,000 Swiss franc. Next point. The company wanted to maintain, or the bank wanted to maintain a cash balance of 30,000 Swiss franc. Wanted to maintain a cash balance of 30,000 Swiss franc. And therefore they need to go, therefore they need to go ahead with the spot purchase. Therefore they need to go ahead with the spot purchase of 5,000 Swiss franc. Spot purchase of 5,000 Swiss franc. Full stop. This will make the cash balance as 30,000 Swiss franc. Cash balance is 30,000 Swiss franc and an exchange balance of 0. Next point. The bank wants an overbought position of Swiss franc 10,000. Overbought position of Swiss franc 10,000. Full stop. This would be possible by entering into a forward purchase contract. This would be possible by entering into a forward purchase contract of Swiss franc 10,000. Forward purchase contract of Swiss franc 10,000. Okay, let's move to question 3. I'll come back to 2 in some time. Let's move to question 3. Go through the question. Go through question 3. Okay. Now in this question, what is happening? There's a bank in Amsterdam which wants to buy rupees 25 million. They have GBP with them. So what they do is they transfer this GBP to Bank of London. What Bank of London is going to do is they are going to convert this into dollars, and finally the dollars will get converted into rupees. So they will convert into dollars, and then this dollars or the rupees gets transferred to their account in India. Now from a problem solving point of view, none of this matters. What is they've given Loro account, Vostro, Nostro, nothing matters. I have a known component, I have an unknown component, and I end up doing the problem. What is a known component here? Rupees 25 million, right? Known component equal to rupees 25 million. Known component equal to rupees 25 million. Unknown GBP, that's all. Let's write the formula. GBP equal to, what's the formula? INR into GBP by INR. What are we doing with INR? We want to purchase it. Bank wants to sell. Bank will sell at ask rate. Expand the formula and get to the answer. Expand the formula and get to the solution. Any doubts in this? Can you proceed? Any doubts in this question? You will get an answer of 266,982.28. As such, we didn't use the understanding of was true, not true there. It's just the known component and unknown component. Any doubts in this? Can we proceed? Clear? Let's come to this question. Question number 2. Omega Electronics Limited exports air conditioners to Germany by importing all the components from Singapore. The company is exporting 2400 units at a price of euro 500. The cost of imported components is Singapore dollar 800. Fixed cost and other variable costs are 1000 and 1500. Cash flows in foreign currency are due in 6 months. The current exchange rates are, after 6 months the exchange rate turns out. You are required to calculate the loss or gain due to transaction exposure. Some additional information and the loss or gain due to transaction and operating exposure. Please go through this. The first part of the question is asking profit or loss due to transaction exposure. Now, what is due to transaction exposure is, I'm going to calculate the profit as if the realization happens today, and next profit as if the realization happen after 6 months. Anyway, in reality it's going to happen after 6 months. Whatever is the difference in the profit between these two levels, that's the profit or loss due to transaction exposure. My currency is either giving me profits or giving me losses. So these 2400 units, today I will calculate the profit based on these exchange rates. Then I'll calculate the profit based on these exchange rates. There is going to be a difference in profit. That difference in profit is called as loss or gain due to transaction exposure. Next time what they are saying is, we have made certain changes. They have said that we are going to change the selling price to something and some exchange rate, some information is given. Let's assume original profit is 20 lakhs. Profit after 6 months is 8 lakhs. 20 minus 8 is the loss due to transaction exposure. Then again I want to calculate the similar numbers, original profit and profit after 6 months. The original profit is 14 lakhs and profit after 6 months is some 4 lakhs. Like we had done an original calculation, the difference between 4 and 14 continues to be transaction exposure. Transaction exposure is the profit or loss due to currency movement. But this 20, no, originally itself is becoming 14. That is a loss due to operating exposure, because you have changed the way you are operating. Whether you are changing the number of units, more units, less units, selling price changes. So that difference is called as loss or gain due to. So I need 4 numbers to do the problem. Profit if currency is realized today. Profit if transactions are realized after 6 months. Revised profit if transactions are realized today, revised profit if transactions are realized after 6 months. With these 4 numbers, we will be in a position to answer the 2 parts to the question. Any doubts in this? Operating exposure means the overall profits is undergoing a change because of change in operations. Whereas transaction exposure is reduction in profit due to the transactions which the company has been, due to the currency changes which are happening. Working note 1, calculation of profit. Working note 1, calculation of profit as per existing condition. Calculation of profit as per existing conditions. Now, profit on day 0 based on spot exchange rate. profit on day 0 based on spot exchange rate. On day 0 based on spot exchange rate. That is, we will take the spot rates and try to do the calculation. Particulars amount, particulars and amount, or particulars calculation and amount. I'll create the format, you guys try to fill it based on spot exchange rate. Okay, the format will be like this. Listen for 2 minutes. Selling price, imported component, variable cost, contribution per unit, total contribution, less fixed cost, and you get your profit. So you can try to fill this based on the spot exchange rates. You know the number of units data and all is there. So try to fill this based on the spot data. Spot exchange rate, selling price, imported component, variable cost, contribution per unit, total contribution, fixed cost and profit. Try doing this. I'll explain in case you're stuck. What is the selling price? 500 euros into what price? 500 into 51 point. It will always be the lower rate for the revenue, higher rate for the expenses. 500 into 51.50. Imported component is 800 into 27.25. 800 into 27.25. Imported component is 800 Singapore dollars into 27.25. Now the same thing, profit on day 180, profit on day 180. Any doubts on 34,80,000? Any doubts on that number? Profit on day 180 based on expected exchange rates. Based on expected exchange rates. Any doubts on this? 31,20,000. Now below that you can write loss due to transaction exposure. 34,80,000 minus 31,20,000. This is the amount of loss for part 1 of the question. 3480 is coming down to 3120. Loss due to transaction exposure 34,80,000 minus 31,20,000. 3,60,000 of loss is going to happen. We are going to have a loss of 3,60,000. 3480 is coming down to 3120. So there is going to be a loss of 3,60,000. Any doubts on this? Clear? Can we proceed? Now I need to prepare a similar statement, but the only thing is I need to be very clear on what is the number of units we are selling. Some price elasticity part and all is given. Exactly the same format, profit on day 0, profit on day 180. But before doing this, let's do some base work on it and then we start it. Now they are saying, based on the additional information, calculate the loss or gain due to transaction and operating exposure if the contracted price of air condition is 25,000, exchange rate changes to, price elasticity of demand is 1.5, payment and receipts are to be settled at the end of 6 months. One thing what they have done is they have given some new exchange rates now. The expected exchange rates after 6 months will continue to be same, and there is something called as a price elasticity of demand. What do you mean by price elasticity of demand? What is the use of elasticity of demand?
Determine the relationship between the demand and supply.
relationship between the demand and the price. Now they are saying elasticity of demand is 1.5. What was the old price for us? Old, what was the price? 500 euros. Now what is the price? 25,000. I'm not sure whether I've increased the price or decreased the price. I'll have to look into these exchange rates and see whether I've increased the price or decreased the price. If I have increased the price, number of units sold will come down. If I have decreased the price, number of units sold will go up. Next working note, calculation of units sold for the revised scenario. Calculation of units sold for the revised scenario. Point number A, the company had fixed a selling price of rupees 25,000, has fixed a selling price of rupees 25,000 in place of 500 euros. In place of 500 euros. Next point, 500 euros based on given exchange rate. 500 euros based on given exchange rate will translate into 500 euros based on given exchange rate will translate into, can you translate and tell me how much it will be? 500 euros based on given exchange rate will translate into 500 into 51.75, 25,875. Full stop. This indicates that company has reduced its selling price. Company has reduced its selling price from 25,875 to 25,000. From 25,875 to 25,000. Any doubts on this? Next, percentage fall in selling price equal to 875 by 25,875 into 100. 2 decimal answer. Percentage fall in selling price equal to 875 by 25,875 into 100. The base price. What percentage? 3.38. Okay, 3.38 percentage. 875 by 25,875 into 100. So 3.38 percentage fall is there in the selling price. Any doubts on this? Next point, elasticity of demand is 1.5 times. Elasticity of demand is 1.5 times. Of demand is 1.5 times, which indicates that of demand is 1.5 times, which indicates that 1% fall in selling price, 1% fall in selling price will lead to an increase in volume, by 1.5%. Will lead to an increase in volume by 1.5%. Next point, increase in volume equal to fall in price into 1.5 times. 5.07% is going to be the increase. Fall in price into 1.5%. Any doubts on this? Clear? Next, units sold equal to 2,400 into 1.0507. That's you are adding it by 5.07 percentage. You can round it off to 2522. 2522. We are going to sell 2522 units now. Fall in price, increase in volume, and we are going to sell 2522 units. Any doubts on this? Any doubts on 2522 units? Now listen. You are going to recreate this statement, profit on day 0 based on spot exchange rate, just that it is 2522 units. Take care of the selling price changes and all. Do the statement again. Calculation of profit as per revised conditions. Profit as per revised conditions. You will be selling 2522 units now. Profit as per revised condition, it's going to be 2522 units. What is the selling price in the revised scenario? It will be straight away 25,000. No currency changes will impact it. It will be straight away 25,000. This is going to be 827.15. The currency exposure is now only for imported component. You don't have the exposure for your euros. What should be the fixed cost figure? It should continue to be 24 lakhs. Don't change it. It should continue to be 24 lakhs. So the original base profit itself is coming down to 20 lakh 89,000. Earlier the base profit was some 34 lakh rupees. That itself has now come down to 20 lakh 89,160. That's because we made certain set of changes. The base profit has come down to 20,89,160. Similarly, here it will continue to be 25,000. The only issue is going to be this 800 into what rate was there? 27.75 minus 1500 complete the drills. Let me know if there is a doubt. These are the four numbers you should have got. If you have done till this, then I explain the final part. Are these four numbers you are getting? These are the four set of numbers. You can write it like this: original and the revised set of conditions, day 0 profit and day 180 profit. Can we discuss now? Anyone has any doubts in these set of numbers? The most important one was the 2522 calculation, which I have taken you through. Beyond that, it's more of a simple profitability statement. Any doubts in these four numbers? Can we proceed? Any doubts in this? Now, loss due to, listen for some time, due to transaction exposure, loss due to operating exposure. Now, my transaction exposure is there for both the scenarios because anything can happen to the currency movements. So, in both the scenario, I lose because of transaction exposure. 34 become 31 or 20 become 8. But operating exposure is only this. Day 0, what was the profit vis-a-vis what is the day 0 profit? So from 34,80,000, we have a loss due to operating exposure of this much. We get a revised profit of this. Because of transaction, we have a loss of 12 lakh 10, and finally we end up with a profit of 878,600. From 34 lakh 80, it comes down to 878,600 because there is a loss due to operating exposure of some 13 lakh, and there is a loss due to transaction exposure of some 12 lakh. Transaction is currency movements. Operating is changing the price, changing the units sold, changing the purchase price. All of that will get factored into your operating exposure. Clear? Any doubts on this? Please complete this. We'll take a break of 30 minutes.